Good morning, it's Jeffrey Christian from CPM Group. It's about 10:30 in New York on Friday, the 15th of April. Wanted to talk about gold today and maybe show some things that people don't normally see. You know, we released our gold yearbook a couple weeks ago. It's a fabulous 200+ page book that has all kinds of details about statistics on every aspect of the gold market, the real gold market, every aspect on the real gold market. We also, do our monthly precious metals advisory, and we do 10-year projections for gold, silver, platinum group metals, manganese, moly, tantalum. Actually, some of those metals we take out 28 years right now, 2050. So I wanted to talk about gold and where the gold market is as of the second quarter of 2022, and maybe show some charts and talk about some aspects of the gold market that are from the gold yearbook that people who don't subscribe to the gold yearbook and are not as steeped into the gold market as we are don't necessarily see. This is a chart that is from the gold yearbook, and it's actually from the review and outlook right up front. And we like to point out that investors own more gold than governments, than central banks and monetary authorities do. And that's really been the case since 2006. And we remember, when those two lines crossed. And we thought it was a very significant issue because it really represents the democratization of gold. And it represents broader trends in the financial markets where individual and institutional investors, unfortunately, a lot of it's institutional investors, but investors, the private sector, if you will, were gaining market power over governments, and significant issue. We've seen since 2006, for a couple of years, central banks continue to sell gold on a net basis. Since that time, they have been rebuilding their positions. They don't have as much gold in their central bank monetary reserves as they used to, although on a dollar value, it's much larger than it was when they had the price fixed at $35 an ounce. But the gap, obviously, between private ownership of physical gold and government ownership of physical gold continues to expand as that economic power shifts from governments to individuals and corporations. That's in the gold yearbook. This is a chart that actually appears in the gold yearbook, but we also update it on a monthly basis in our precious metals advisory. And it's basically a color-coded issue. There's 6 broad topics, factors, sets of reasons why investors would buy gold: as an inflation hedge, a currency hedge, as a safe haven, a portfolio diversifier, an alternative asset, a form of savings, and as a commodity. And we have always, this goes back to 1979, we have always sort of paid attention to these, and we color code them, red, green, yellow. Red is a factor that is not necessarily compelling for investors to be as a reason for investors to buy gold at a given time. Yellow is neutral, and green is positive, although it's kind of a bluish green. And you can see at the bottom there's a positivity factor, which is just the average of them. And our estimate is that last year we were at about a 67% level, down from 83% in 2000. And this year we're at about a 75% level. And that actually ties in very closely with what's happened with gold prices, which shot up very sharply in 2020 and rose a little bit on an annual average basis in 2021. And we expect it to rise, gold prices to rise a little bit more. It also ties in with our estimates of historic gold demand by investors, which was very strong in 2020, a little bit less strong, but still historically high in 2021. And we expect it to stay about 2021 levels in 2022, perhaps a little bit higher. And we are seeing investors load up on gold. And that's actually the major thing that I wanted to talk about. Investors are loading up on gold. On the left hand, you see the gross and short, long and short, and the net positions of gold of investors, institutional investors, on the COMEX futures and options exchange. And you can see in the blue, which is the gross long position, really over the last 3 years since 2020, the gross long positions have been at record levels, and they have been higher than they were in that period, 2008 to 2011, when we saw a big surge in investment demand and gold prices moved, from $700 in 2007 to $1,100, $1,900 in 2011. Investors in the futures and options markets are more invested in gold now than they were back then. And on a net basis, you can see that the net positions also are at high, if not record levels, they're very high, and they're higher than they were more or less than they were in 2008, 2011. So you have a basically positive attitude toward gold on the part of institutional investors in the futures and options market. The right-hand side is ETFs. And again, we're at record levels. And we're seeing an increase in the last few months overall in the amount of gold held there. We're a little bit shy of 140 million ounces of gold held by ETF investors. That's interesting because our estimate is that we're about 1.4 billion ounces of physical gold that investors own worldwide. So what we've seen, if you go here, 1.4 billion ounces, and ETFs came into play around 2006. ETFs are becoming more important as a way for investors to buy and hold gold. And they now represent roughly 10% of physical gold held by investors. So they've become much more important since they were created, and they continue to be important. The third leg of the investor area is coins, and the US Mint publishes monthly data, and you can see that they're up about coin sales in the first quarter for gold coins, eagles and buffaloes, up about 15% from last year. But last year was up 47% from the year before, and the year before, 2020, was up, 400%. So we've seen a big surge in investment demand. The chart on the right shows you the big surge in 2020 came off, but it's still very high compared to those 2017, 2018, 2019 period when gold prices were kind of flat and investors were disinterested, shot up in 2020, and it came off last year. It's rising some more this year, but it's not back where we were in 2008, 2011, but it's off out of the cellar where we were in that period from 2000 to 2007, and in that period from 2017 to 2018. So you put it together, and investors are interested in gold. And there are a lot of reasons for investors to be interested in gold. They're buying gold coins, they're buying more gold coins, they're buying more gold ETFs, and they're trading futures and options more on the long side. And as you know from our previous talks, that's sort of the main driver that we follow in terms of gold price trends is in private sector investment demand. There are record levels of bullion in New York and in London. In New York, we have it broken down both eligible and registered. Registered levels inventories are at record highs, as are eligible levels. And in London, you're at record levels as well. And again, the COMEX data is 100-ounce bars. So, and I guess I think they allow kilo bars now for delivery too. So all of the gold coins and all of the gold, if somebody owns a 400-ounce bar, all of the gold that doesn't meet COMEX specs that are in those depositories doesn't get included in the eligible and registered. But just looking at the gold that can be delivered against COMEX positions, we're at record levels. And we're at record levels in London. So a lot of gold around to meet that investment demand. And in fact, a lot of this gold is owned by investors, especially the eligible and the stuff in London. A little bit of total supply. This is also from our gold yearbook. You can see that mine production fell from around 2017 into 2020. Well, 2020 was the lockdown. It was a little bit up, not really a great recovery in 2021, and we expect it to be up a little bit more. Total supply was relatively flat and has done better because you've seen more gold recovered from secondary supply, mostly jewelry, but also electronics and other factors. Part of that is a function of the higher gold prices, bringing in more old jewelry and decorative items to be recycled. Part of it is regulatory tightening on end-of-life electronic equipment, where there's greater recycling and recovery of the gold and other metals in the electronic equipment at the end of life than there used to be when it was just dumped in a pile. Looking at fabrication demand, here are two charts from the gold yearbook. One is total fabrication demand, and you can see the red and the blue are jewelry, and you can see that it represents the vast majority of gold that's used in fabricated products. And fabricated products in most countries have a legal definition, and it's usually 3% or greater value added to the raw materials. So if you're taking a gold bar and you're making gold coins or medallions or investment products, and you're adding 1% or 2% in the value in that process because you're taking a 100-ounce bar and breaking it down into 1-ounce bars or kilo bars or whatever, that's not a fabricated product. Fabricated products are things that have greater value added than their raw materials. The chart on the right's an interesting one because you can see here, jewelry demand is the bulk of gold demand. You can see investment demand is very choppy. There are periods when investors want to buy a lot of gold and they are more significant and important in the market as an offtake source. There are periods when they don't want to buy as much gold. And if you look at this, we have in the gold yearbook, I didn't include it here just for space and time issues. If you look at it in the gold yearbook, we have a chart which plots jewelry demand versus gold prices. And you can see massive growth in gold jewelry demand from, say, the early 1980s into the late 1990s. And that reflected lower gold prices, deregulation of gold and gold jewelry markets around the world, increased demand, rising disposable incomes and investable incomes. So people were doing better in most parts of the world, and they were buying more gold jewelry as a result. And that price was there. And the price is a very important factor because jewelry demand keys off of the price. And when the price of gold rises, you'll see jewelers using less gold per piece to keep that gold jewelry affordable. And you'll see investors or consumers buying less gold jewelry. So you can see that after 2000, when the gold price started rising, the amount of gold being used in jewelry actually declined. You see that on the left-hand side, and you can see that its share of gold offtake or absorption actually declined as well. This is a chart from the gold yearbook that we've been pulling together. The yellow is futures and options exchanges trading volume. And it's not just COMEX. COMEX is the lion's share of it, but it's Shanghai and TOCOM and a host of other less important or less volumetrically important gold futures and options exchanges around the world, including in India, China, Tokyo. And you can see how that has risen since 1997. The data goes back to 1997 because that's when the London banks, through the LBMA, began collecting and publishing data on their clearing volumes. They've started collecting and selling their data on trading volumes in the last 2 or 3 years, but their clearing volumes, they started reporting back in 1997. And you can see back in 97, 98, there was about 9 billion ounces of gold changing hands, clearing across banks, not internally within a bank, per year in those 2 years through London. And it wasn't nefarious stuff. It was primarily investors, institutional investors, and proprietary trading desks at banks and brokerage houses trading gold back and forth. As the 90s wound down, a couple things happened. One was that the gold price fell. We entered a 5-year bear market from 1997 through 2002. But another thing was that the trading patterns at banks and institutional investors kind of dissipated and moved away from gold. And you saw those volumes go from 9 billion to 4 billion during that bear market period. And they've started to rise, and they're about 4 or 5 billion now. So you can see the volumes on London versus futures and options. We have a table in the Gold Yearbook which breaks this all down and shows you the data year to year. What about putting these charts out? These are 2 charts from our Precious Metals Advisory. Every month we come out with our Precious Metals Advisory, and we give our subscribing clients our view as to a range, an average price for the next 3 months. This is the range that we think, and you can see at the beginning of April, we were thinking that the gold price could drop if there was some sort of resolution of the Ukraine war, and it could go as high as 2,100. It hasn't gotten to 2,100, but you know, the month's only half over. And then we have a slightly broader range for May and June, with the anticipation that there are several factors that will be happening, including perhaps a half-point increase in interest rates we read today. But you know, the FOMC is meeting in May and June and July, and so you may see 3 interest rate hikes in that period of time. You may also see some movement toward a resolution or a stalemate in the Ukraine invasion by Russia, so that you could see some of that war premium and some of that inflation premium come off, and you could see the gold price decline. You also have seasonal factors. We have a gold seasonality chart in the Gold Yearbook, and it's interesting, you know, in the stock market, they say sell in May and go away because the stock market tends to weaken in June, July, and August. If you look at the gold price seasonality, gold prices tend to weaken in June, July, and August as well. So we're always telling our clients, you know, sell in May and go away for your stocks, but gird your loins for buying gold at a lower price in June, July, and August, because that's the period of seasonal price weakness. And we kind of expect that again this year. It's a little bit present on the right-hand side. This is quarterly average prices over the next 2 years. And again, we update this actually on a continually basis, but we publish it every month in the Precious Metals Advisory. And we talk in these videos about where we see the price going, but we usually don't provide these charts because people pay good money for a subscription to the Precious Metals Advisory, and you can too. That's about all I have right now. I just wanted to talk about some of the fundamentals of gold and some of the things that maybe, you know, viewers of these things, videos, don't necessarily see on an ongoing basis. That's where we are. We did come out with our Gold Yearbook on the 6th of April. We'll be coming out with our Silver Book on May 10th, and then the Platinum Group Metals Yearbook at the end of June. We have our retail investment program, and we're working on a variety of other things to roll out in terms of that. It's a very busy time here. We provide research, and we provide consulting, and then we help investors manage their assets, corporates manage their commodities exposure, and we provide advice on both the buy side and the sell side in terms of investing in commodities-oriented assets. That's all we have for today. Have a good weekend. It is a religious weekend for many Western and Occidental religions, Islam, Christianity, and Judaism. So everybody that participates in those religions, best wishes. And everybody who doesn't participate in it, best wishes. Be good to others, and we'll talk to you next week.